So where do we stand in June looking at the fundamentals for the stock market? Well, we're in a very good place. Both the S&P 500 and the Dow are nearly breaking out to new all-time highs again. The Nasdaq is a little bit trailing, but getting closer to its all-time high, as are the small caps. But market fundamentals are still looking good despite being back at the all-time highs. Why is that? Well, earnings are on the rise still. And the analysts are underestimating what's going to happen in the second half of the year. So that is bullish for the stock market. A lot of people talking about valuations, but valuations aren't really a concern here. And I'm going to take you in to show you why in a moment, but valuations still looking good. Also, fundamentals for me always depends on what's going on with the job market. So I brought some charts to take a look and see at what is happening on job openings, where we are with the quits, all the other kind of job fundamentals underneath the surface of the solid job report we got for May. Not quite as good as what everybody wanted, but it's good enough and it's going in the right direction, and that's what we need right now. But the underlying data, like I said, is pretty strong. So let's dive right in and take a look at some of these charts I brought you from the Fed, the Federal Reserve of St. Louis. They've got some great charts with all the data, and we're going to be getting more that's going to update some of this data I'm about to show you coming here in June. So be on the lookout for that, because I think it's going to surprise us and be even better than what the individual monthly claims are looking like. So let's dive right in. Okay, so the first chart I brought you is this Fred chart, which is the weekly continuing claims. And you can see that those are still dropping. This is one of the key things I look at are those, people who are first filing and then the ones that are continuing to file week after week. We need it to keep going down, and it looks like it continues to. So this is a positive. That means people are finding jobs finally, those who have been collecting unemployment for multiple months here. They're getting off the rolls and they're going back out there and getting jobs as the economy is reopening here strongly. So this is a key thing, and this continues to go in the right direction. Then we're going to have the job openings. Now, we're going to get new data for this coming up soon because it's every 2 months here. So this is going back a couple of months already, but there's no indication that this has changed, because on the reopening, we're hearing all these stories of everybody not being able to find anyone to do the jobs. So the job openings are definitely still staying above these 10-year highs. They were above 8 million, and looking for them to be, even hotter than that. I'm not sure if we're going to get to the 9 million suddenly, but we could see, mid 8.5 millions of jobs open. And this is going to be key to the reopen. And this is something for sure everybody should be watching. Then we're looking at the quits. Now, this has been rebounding as well. And what does the quits show you? That means the job market is actually good enough where I'm sitting in my job and I'm like, you know what? I'm tired of doing this. Or I was just sticking it out while the pandemic was going on. So I'm going to quit because I know there's another job I'm either being recruited for or I'm going to apply for and I know I'm going to get. And so the quits are a very good indicator of a strong underlying job market. And we've had the good quit chart all the way since the Great Recession. Slowly but surely, people getting more confident in their ability to go out there and get another job, so they're able to quit. And then took a hit during the pandemic, but is back up to those levels. So this is key. We're also going to get an update on this chart here in June. So this is definitely one to also watch. And then we're going to just take a look quickly at the leisure and hospitality job openings, because this was the hardest hit area of the economy. And this is also showing what we wanted it to, is that the job openings have come back fairly quickly, even while the pandemic was still ongoing. And now that it's reopening and those capacity restraints are being removed and the big hotels have reopened and the cruise ships are starting to resume and all of these things with the rock concerts and, public events outside that are considered leisure and hospitality, including tourism, all of those jobs are coming back. So you can see those job openings are now at the decade-long highs. And that is also something that is a positive here, because we may be seeing some actual growth in this area, not just a rebound to the pre-pandemic, but actual new businesses opening and more hiring than pre-pandemic here. Okay, so what does this all mean for the stock market? All of this is a good sign for the stock market, and it's why the stock market continues to run higher. But the big question is it overvalued? So I took a look at our data here at Zacks, and I consulted with Sheraz Mian's earnings updates that he does every week here at Zacks.com. You can check them out on our website because they're full with great information about what's going on out there with earnings. And I discovered that it's a good situation with earnings and even with the valuation component. So the S&P 500 here in 2021 is around 23 times. That's a little pricey, right? That's where the concern gets with the stock market. But by next year, because those earnings are moving higher, the forecast is expected to be just 20.7 times. So that's not so bad, especially with the hot economy going in. People are, willing to pay a little bit more for these earnings because those earnings keep rising. But the interesting thing is the second quarter earnings, which were coming up in July, we're going to get the second quarter earnings season beginning. Those earnings are expected to be up 7.8% from the pre-pandemic second quarter in 2019. So that is key to where we see the economy going and earnings. So yes, year over year, we're going to see a big gain. I'm going to show you what that is looking like. But that would be normal because second quarter is when the economy was basically shut down. So earnings got crushed down in second quarter last year. They have rebounded, so you're going to get a big bounce. But this data confirms that our second quarter here in 2021 isn't just about the bounce off the 2020 lows. There is real growth going on. So that's important. And as we can see, here's what it looks like. This is the bounce, and analysts continue to get more bullish about the second quarter. So earnings now expected to be up 59% year over year versus just 41% a couple of months ago when everyone knew this year would see a big bounce but didn't know how big. And then we had first quarter earnings season, which was far better than what everybody was expecting. So they've gotten more bullish, the analysts, about the second quarter. But in my opinion, I don't think they're bullish enough, and they're still going to be underestimating what is happening out there. Then taking a look at the quarterly earnings and revenue growth here, this is, multiple quarters coming up. So you can see right here, the 59% big gain in the second quarter, but still 21% gain on earnings for the third quarter, and then 16% for the fourth quarter. But like every year, it gets a little more dubious the longer you go out because the analysts are, they can be bullish about the end of the year, but they really don't know. They can say kind of like, yes, we think it'll be good, but they really lose, ability to look that far ahead. So while this is bullish that those earnings estimates are going up, I would expect to see continued further revisions on both third quarter and fourth quarter moving forward here. That's also bullish for the underlying stock market as far as fundamentals. And then we're going to finish up by looking at the tech stocks because everybody's worried about tech, right? That, that got overextended in 2020. Many were considered to be essential businesses. The stocks soared. And now here in 2021, the stocks aren't doing much. But while those stocks are treading water, the earnings are not. This is from Sheraz's write-up that he puts out. And, he's talking about the technology sector. So it had a great first quarter. This is what confuses everybody. Hey, those earnings were great. Most of the companies were beating. Look at that revenue growth in the first quarter, 22%. That's strong because the pandemic hadn't quite hit yet in the first quarter in 2020. So you're still seeing really strong revenue growth. And even here in 2021, 17.7% expected on the revenue growth side with another 31% earnings growth. So while these stocks aren't going anywhere because of their big rallies last year, the earnings are on the move higher. And what does that mean for the underlying stocks? Well, it means they are getting cheaper. I'm not saying they're cheap value stocks by any means here, but the longer they tread water while that E is rising means their valuations come down quite a bit and they get more attractive. And that could mean another leg higher for stocks on the tech side, including the NASDAQ. So that's something to watch here, that valuations are not an issue with the stock market right here in June because these earnings are on the move. For all the key sectors, I'm just showing you the tech sector because most people are invested in this. And, these are some of our favorite stocks. But energy is expected to be the big driver here in the second quarter. And that is also the best performing sector in the stock market. Now, it's so small as a percentage of the S&P 500 now. I think it's less than 5%, that it's not really moving the S&P 500 the same way that technology could if this starts to rally again. But that's something to keep in mind as you're thinking about the fundamentals and where the stock market stands here as we start the summer of 2021. Valuations are not a concern. Maybe even overheating might be a concern, but as we are getting possibly another breakout in the large cap indexes, valuation is, again, not a concern and is basically fueling what is happening on the rally here. So that's a look at the fundamental side, and fundamentals are strong. So I'm staying fully invested as we move into the second half of 2021.
All right, let's take a look at some charts and get a technical view of the market. Here's the NASDAQ 100. I'm talking about this. I thought we'd go lower here in late May, come down and take out basically 13,000, and we did not. I mean, buyers are hungry here, right? And, back above the 50-day, so the question is, do we grind sideways here in June before a bigger rally I expect into August? Quite possible. So obviously, S&P, materials, energy, that stuff's doing great, sustaining the S&P. But we want to see the return of growth where, stocks we can sink our teeth into growing revenues at 20%. Because if you grow revenues at 20%, you can double them a lot quicker. And anybody growing revenues at 40%, they're doubling their revenue in 2 years, right? So, obviously, let's look at where the growth and where things are being held back a little bit. We'll go to software here, the IGV. Which is big cap weighted. So obviously Salesforce, Adobe, Microsoft dominate this thing. But, the buyers are coming in. And if we can sort out this sideways action, we're going to see new highs here. And I think we'll see them into summer. All right, what else do we want to look at? Let's take a glance at the S&P equal weight. Speaking of the S&P, first, let me show you NASDAQ 100 a breadth indicator here. So basically, this is the green line is the percentage of NASDAQ 100 stocks above their 50-day moving average. This, this is a 1 year look, and this is bullish to me because, we're right at the mean right now, around 67%. That's we're right in here. 67% is the mean, and we made a higher low. So the March correction did some damage, but it was a buying opportunity. We come back down here in May with a higher low, and so we have a setup here into the summer to get back to real strength, where you get you get 80% of NASDAQ 100 stocks above their 50-day. So, right now, Facebook and Google are strong. Amazon has pulled back a little bit. Those will play catch up. We'll look at another aspect of the NASDAQ 100 in a moment. Let's first go to the S&P equal weight to give you an idea of broad market strength. You want to look at equal weight. So this is the S&P 500 equal weight. You can go to stock charts and just type in SPX EW and you get this look. I mean, if that's not a strong bull market trend, I don't know what is. All right, so I wanted to show you another way of looking at the NASDAQ, but not the NASDAQ 100, what I call the NASDAQ 200. It's not 200 stocks. It's the second 100 stocks. It's the, it's where CrowdStrike is. It's where Shopify is, things that aren't in the NASDAQ 100. And you put in QQJ. This is the new ETF that Invesco created last fall they did this. And this gives you a look at, what are the next generation? That's what they call it. It's NASDAQ Next Generation 100 ETF because it's the stocks from 101 to 200. These are looking good. Again, finding support here. This looks, a lot of charts look like this, like the Square chart looks like this, the Shopify chart, the other things are held back, like my trade desk is down below those lows. But I think this bodes well, too, for a rally into summer. Whether that's we go sideways in June or we have one more dip to test support, you want to be a buyer. And I think that's what we're seeing now with institutions still buying growth stocks, still looking for the values they can find in growth, seeing that, there's no crisis coming. Nobody's running for the exits. All right. Thanks for joining me. We'll talk to you in the next segment.
Kevin Cook and Tracey Ryniec agree to disagree right after this list of recent Zacks Ultimate Top Movers.
So, do you own an electric vehicle? I don't, but I live in downtown Chicago and I'm a little leery about how do I charge it? Where do I go? Are there going to be enough charging stations? I know everybody's talking about electric vehicles taking over, destroying the oil companies, and Elon Musk being king of the world basically by 2030. That's what Kevin Cook is going to tell you when he discusses his side of our agree to disagree on electric vehicles. But my side is we're not quite there yet on infrastructure or what do I do? Where do I go? Doesn't mean it won't ramp up. But in the meantime, the oil companies are not going to be destroyed. And you got a couple of years or maybe even a decade before you really have to worry about that. But let's take a look at where we stand with electric vehicles and that infrastructure, because I think this will give you a closer view on what is actually happening out there. So I can argue my side is that we're just not there yet in terms of being prepared for everybody to have electric vehicles. But let's take a look and see. So basically, currently, electric vehicles are just 1% of all cars and trucks on the road. So think about that, just 1%. And electric vehicles are just 2% of all new car sales. Now, again, this can be ramped up quickly. A lot of the automakers are now coming out with more and more different models of the electric vehicles. And now we're going to get the trucks from Ford and other automakers. That's going to be huge because these are, popular vehicles. And once you get truck drivers converting over, then it's going to gain momentum. But right now, just 1% of those cars and trucks are on the road. Now, New York Magazine recently had an article about the charging stations in New York City. The guy who wrote it got an electric vehicle and had it for I think a week. And he, drove it all around, including out to Long Island to see what happens when, the battery goes down. Can he find places to charge it easily? What happens with that? And surprisingly, he didn't have that hard of a time doing it. But again, we're at just 1%. What happens when it's 10 or 25% of all those people in his Manhattan neighborhood that now have electric vehicles and are all trying to go to that one parking garage, charging station? And by that, I mean, how many charging stations are there and where are they? So as of May 2021, there are about 50,000 public charging stations in the United States. These aren't the ones that you would have in your own garage where you just plug it in. These are if you're out and about and you're at a hotel somewhere, or you go to the supermarket, or you're, visiting someone. How do you charge? Well, they're mainly in public parking garages. They're in grocery stores, like outside of Target. They're at strip malls. And a lot of those are reasons where, hey, I'm going to the Target. I'm going to be in there an hour. I'll just pull up, charge it while I'm in there. And it would be like a quick charging station for those. But out of the 50,000, which sounds like a lot, but really is not, California has half of those stations. And some states have under just 200 public charging stations. That includes Alaska, which the last data I saw on the Energy Department's website, they have a whole map you can go to. That data showed just 67 public charging stations in all of Alaska. And North Dakota was at 130, I think it was. So if you're driving to any of those areas, you're in a little bit of a bind if you want to actually charge. So President Biden's infrastructure plan wants to build 500,000 stations by 2030. This is key to the rollout of the cars, as we're discussing, because without that charging station, why am I buying the car? I'm going to be a little too scared that I'm going to be stuck somewhere and not able to find the station. So some of the charging station issues have been in the news recently. Like I mentioned, that New York Magazine article. And now, just recently, 7-Eleven has announced that it's going to install even more charging ports because, again, this makes sense. A lot of people just going to the convenience store, and you might as well plug into the fast charging stations. So they already operate 22 charging stations here at 14 stores. They expect to install 500 of the fast charging stations, but at 250 stores by the end of next year, 2022. Again, this is great news, and it's good to see these companies in the private sector stepping up and putting the charging stations in. But this is basically 2 charging stations per store. And again, we're only at 2% of all autos and trucks being electric. What happens when it's 10 or 25% or even 50? Those 2 stations at just this one 7-Eleven is unlikely to be enough. And maybe even just 2 stations at the Target or 5 stations at the Target. We all know pulling into the gas stations, sometimes we have to wait there to refill up. What's going to happen at the charging stations at these other locations? And can we build them fast enough? My argument is that we cannot, that there won't, that we're still going to need oil to fuel through the gasoline, our regular, gasoline-powered cars for quite a number of years, especially in the more rural areas where it's going to be less likely. But the urban areas are just going to need a huge investment in the infrastructure, because while the New York Magazine writer, again, was able to find the charging stations, some were behind closed, gated-off parking garages, but many were in publicly available areas he could go to, like a Whole Foods or a Target or those kind of things, or a parking lot that was accessible to anybody just pulling in. But this is going to be a problem in the cities. All those parking garages are going to have some kind of charging stations. Every condo or apartment building that has parking in it is going to need to add these stations, and more than just one station is my guess. So that's going to take time. So yes, oil and Elon will ultimately be the big story, and the oil industry is going to shrink dramatically, but it's going to take a lot longer than what people believe. So Kevin's going to give you his side about why he thinks the other way, and that will be interesting as well. We're not in disagreement that oil is going to shrink, but it's only a matter of the timing, and I'm a little more pessimistic that it's going to take a little longer to roll out. But here's what Kevin's going to say, and we'll see. We'll see in a couple of years where this all goes. But this is an interesting area, and a lot of money is going to be spent on the infrastructure for electric vehicles. So Kevin will have more on what's going on with that.
Hey, everybody. Kevin Cook here for Agree to Disagree. This was the question I posed to Tracey. Will history write that Elon Musk disrupted both auto and oil industries? I answer in the affirmative, definitely. Whether you like Elon or Tesla or not, we're gonna go over the facts. So first, let's start with who already believes this. And that would be large investors like Ron Barron of Bamco, 40 billion assets under management. He started studying Tesla in 2012, 2013, and really started plunking down some money in 2014. Bailey Gifford, those Scottish warlords from Edinburgh, managing 250 billion. They love it. I've been talking about this, for 2 years now. Both Barron and Bailey Gifford had to sell some Tesla, not because they wanted to, but more because they had to, because the position became such a large percentage of their portfolios. Just the oversized profits from making 5 to 10 times your money, or 15 times your money, even probably in the case of them. Then there's Geode Capital, giant Boston hedge fund, 800 billion AUM now. You don't hear much about. They were buying at the IPO in 2010, and they've been adding. We'll see that in a minute. And then, of course, there's Cathie Wood, ARK Invest, from the mind of Wood. She has a thesis. I've talked about it before. We'll just take a look at that. Why I was fascinated with where does she come up with this, $6,000 price target. So in January of 2020, so 18 months ago, I did this piece, Tesla to 6,000 and SpaceX to the moon, talking about the innovation from the mind of Elon. But, where does, so I say, did you hear the one about the investor who just raised her price target on Tesla from 4,000 to 6,000 by 2025? In the video, I tell you her name. Well, you already know it's Cathie Wood. Now, where does she come up with this insane price target 5 years out and, 6 years out, really? They're long-term investors. It's all based on autonomous cars and ride hailing, that Tesla would dominate the business because of their technology and their platform accessibility, to markets with 80% gross margins. So, and then, I was talking about Ron Barron. This guy, Ron Barron, thinks that Tesla does $1 trillion in sales by 2030. That's pretty intense. And he's just a long-term believer. He recently had to sell some shares. We'll take a look at what he's up to. But the last person I want to mention is Herbert Diess of Volkswagen. The CEO of Volkswagen said in 2019 that Tesla was not a technology company, or it was not an auto company. It was a technology company and had to be valued as such, as a technology innovator and disruptor. So here was Ron Barron back in just in January, explaining why he had to sell 1.8 million shares of Tesla. Now, he only, let's say for a time he had 1 million shares. Well, then the 5-for-1 split obviously gave him a lot more. And it just became, too big a percentage of his portfolios. Privately for himself, he still owns 1.1 million shares, and he said he's not selling any of them. He said it was painful to even sell any of them because he sees Tesla going to 2,000. Now, back to Cathie Wood, those $4,000 and $6,000 price targets must be put in perspective with the 5-for-1 split. So we're still a ways from there. So let's look at all these buyers here. And I just want to point out, Geode was adding. Geode Capital, they added 400,000 shares. Here's Bamco. This is Bamco down here. This is Ron Barron having to sell some, trimmed a little bit. He looks like he could have bought some back if they were probably talking to him in January about Q4 where he sold 1.8 million shares. So here he trimmed some. And Capital World is obviously in here. They sold 5 million shares, but they had 40 million, cashing in their outsized gains after the 5-for-1 stock split. There's Bailey Gifford selling 11 million shares, but these are all, again, every one that I've highlighted, they're long-term believers. So let's get to the Wood thesis real quick. So ARK estimates that robo-taxis will put at risk the roughly $8 trillion in U.S. public equity enterprise exposure, enterprise value in these sectors: energy, autos, insurance, car rentals, and ride hailing. And if you go to the ARK site, you can download this PDF they have. It's a white paper. It's called Bad Ideas. They did that mock commercial about, hey, don't invest in innovation, just buy the S&P 500 and you'll do fine. Well, that's their investment approach is the opposite of that. Investing in disruptive innovation wins by orders of magnitude over the long run. So you can download this report. It's called the Bad Ideas Report 2020, and they give it's a 20-page PDF. And in 4 pages, they summarize their thesis about how energy, autos, insurance, and all these areas will be disrupted. You can just find it if you just go to the ARK Invest site. You can sort all the research. I put in Tesla and then sorted by most recent reports, and there's the Bad Ideas Report. Here's their original thesis from 2017, why self-driving cars could change everything. And that was by Tasha Keeney, a CFA who works for Cathie Wood. Basically, this is her report too. So this is worth your time to take a look at this. It'll give you perspective on, the basic thesis about ride hailing. I mean, let's look at, here's one good chart they have. So this is the cost of transportation per mile. A taxi, $3.50. And then looking at, private plane, short haul flights, long haul flights, and there's an autonomous taxi at 25 cents per mile. That's only going to get better as the technology improves. You should definitely look at this PDF. It's got everything, it addresses all these sector issues. And if you think about all these areas, energy, one of the stats that the ARK Invest team cites is that they believe that autonomous driving is on an upward curve and people driving their own cars is on a downward curve. Now, you may not picture yourself giving up your car and getting in a robo-taxi anytime soon. But these trends are happening whether you choose them or not. So that's why we're looking. So here's one of their estimates. As robo-taxis take to the roads, ARK estimates that roughly 57% of all automotive miles traveled in the U.S. will be autonomous in the next 10 to 12 years, and that non-autonomous miles traveled will drop by nearly 40%. Now, so let's look at it from the energy perspective. Finally, we believe the $4 trillion oil industry powering gasoline guzzlers has seen its brightest days. Battery system cost declines could lower EV sticker prices to levels below those of their gas counterparts during the next 2 to 3 years, stimulating EV demand to levels well above current forecasts. While the EIA forecasts EV penetration of 2% in 2022, and there was a note there, note 31 for that data. ARC would not be surprised to see 20%. Okay, where else does this show up? Where is the impact of what Tesla has done with disruptive innovation? Where else is it showing up? It's moved the players faster. I mean, without Tesla, do you ever think you would be reading a headline like this? General Motors plans to exclusively offer electric vehicles by 2035. That's a pretty bold statement, and maybe it's partially PR, but the energy is there behind these ideas, and it's getting big dollars to move. You've seen it from the investors, and there's probably investors in infrastructure who are thinking about the trend of autonomous electric vehicles. So, we can all be skeptical about Elon, right? There's plenty of reasons. Are the revenues from carbon credit subsidies? What is the environmental impact of mining lithium to make batteries? Is he an unstable genius? And the techno king in his Twitter tantrums. Then his Bitcoin flip flop. I mean, the guy as a figurehead of a major technology company, he's a little kooky sometimes, and you would think that would worry investors or the SEC, and he gets a pass every time. Does he have too many dreams for one CEO? Probably, but my thesis is he does the right thing by surrounding himself with brilliant talent. He can find and hire top engineering talent around the world, and he does that. All right, my last piece of evidence about how the world is changing because of what Tesla has done, in disrupting autos and energy, is from Ford. This is Jim Farley. He's got a great sense of humor. He goes, he says he happens to love white vans, preferably down by the river. But he's posting some great content, and you may have seen their new F-150 electric truck. I want to go down to May 24th. So it's the F-150 Lightning, they call it. And, Farley says, we know the commercial customer better than anyone. Well, he would say that, right? They trust us to deliver a product that works for their business. The bottom line, this truck is better, more productive product with an eco-conscious upside that we think commercial customers are going to love. So, and again, the pro concept is, they're still going to make internal combustion engines, trucks for the customers who want those, but they're providing something that a certain market wants, and they're getting traction with it in Europe. And it's just a growing trend. So this is my 8-minute thesis on how Tesla has indeed disrupted autos and energy, and getting these big companies to move and getting investment dollars to move into the EV space. All right, thanks for joining me.
Ahead of the Zacks mailbag, here's this list of recent Zacks Ultimate new additions.
Hi, I'm Kevin Matras, and this is the Zacks Mailbag. So somebody sent me an email explaining the challenges he's having with picking stocks and managing his portfolio. And he touched on several things that I hear over and over again from so many different people. So I wanted to address that today. I condensed his email for brevity, even though it's still kind of long. But the person essentially writes this: I end up holding many stocks for extended periods of time. Almost all of the large losses in my portfolio, 10% or more, are the stocks which have not broken even yet. There are stocks that I am holding for several months or even years. I usually don't buy stocks that are making newer and newer highs in the recent time, mainly because of two major reasons. One, there is a big chance that they start to get drawn back at any time and never recover to the same level. And two, I don't know when to sell such stocks, even if I buy them and they start to go south. He then adds, I hate to lose money. What should I do with the stocks that are just sitting in my portfolio but not making any money? All right, first point. I usually don't buy stocks making new highs because there's a big chance that they'll go down. Let me just say that statistically, this is just not true. Studies have shown that stocks making new highs have a tendency of making even higher highs. In fact, using S&P price data going all the way back to the 1950s, it shows that stocks typically go up in the subsequent 6 months following new highs. So this means that stocks making new highs aren't at any greater risk of going down. Quite the contrary, stocks making new highs have a higher probability of going up and making even higher highs. Now look, I get it. I understand why people don't like buying stocks making new highs. They feel like they've missed it, or again, like the stocks have more room to fall. But again, stocks making new highs are a good thing, not a bad thing. And just think about your portfolio. If somebody were to ask you what your best stocks were, you would probably point out the stocks that were going up the most in your portfolio. And then if somebody asked you what your worst stocks were, you'd probably point to the stocks going down the most. And I'm pretty sure that the person who dislikes buying stocks making new highs wouldn't be too upset if the stock he or she was already in broke out to new highs. And why should they be? These are the stocks that people dream about. You want to get in, and then you want to see those stocks take off and soar even higher. And just think for a minute. Can you imagine all of the money you would have left on the table if you were afraid of being in stocks making new highs? You wouldn't own any of your best performing stocks right now. So don't be afraid of stocks making new highs. It is an irrational fear. It is not supported by fact, and it will cost you a fortune in missed profits. Second point, I don't know when to sell such stocks, even if I buy them and they start to go south. I hate to lose money. What should I do with the stocks that are just sitting in my portfolio but not making any money? All right, this part touches on money management. The fact is, there's always going to be poorly performing stocks in your portfolio, regardless of why you bought them or where you bought them. For me, I like using stop loss orders. Whether it's an actual stop or a mental stop, I usually set them at 10% below my purchase price. And the reason why I do that is because it's kind of like a tit for tat, if you will. If you lose 10% on a trade, you only need to make a little bit more than 10%, 11.11%, in order to get that money back. And that's a relatively easy thing to do. But if you lost 30% on a trade, for example, you're going to need roughly a 43% move to get that money back. And worse, if you just lost 50%, you're now going to need to pull out a 100% winner out of your hat to get that money back. So I like keeping losses small. Now, I know some people prefer larger stops, maybe 15 or 20%, and I'm fine with that because those are still relatively easy areas to be able to recover from. Just know, though, that eventually a stock may go down where you're going to cry uncle and you're just going to feel forced to get out. And I know for me, that usually is around 25 to 30%. Plus two, I also know that usually a lot of big losers could have been exited at a much smaller loss. So why not just pull the plug at a less painful area, like 10%, without having to do any real damage to your portfolio? And if there is a compelling reason to get back in, do so. Now, I will also typically ratchet up my stops as my stock is going up. This is called a trailing stop, and it helps you lock in profits so you don't give them back if the stock does start coming down, because eventually your stock is going to pull back one of these days. So it's good to be able to have that in place. But believe me, I hate losing money just like the next guy. But sitting in a loser doesn't automatically make it a winner. It just simply makes it an unrealized loss. And really, sitting in a loser, it's kind of just like ignoring a problem without trying to fix it. Plus two, while you're sitting in that stock, losing money and underperforming the rest of the market, you're also not in a better stock making money. So really, you're compounding that mistake over and over again the more you stay in that losing stock. And honestly, too, I can say that when I do get stopped out of a position or I get out of a laggard position, I actually feel empowered because I'm able to do something that most people are just unable to do. And that also frees me up to be able to get into a new stock with the promise of being able to see better things. And I can get into a new position without the baggage of that loser stock hanging over me. And I'll bet the same will be true for you too. So those are a couple things to give a try.
Sheraz, Mian, and Kevin Cook have the portfolio makeover. But first, these interesting insights from Zacks Ultimate Editors.
Hey, Cooker here for Portfolio Makeover segment today. I chose John, who happens to be a registered investment advisor, a wealth advisor. And he's got a very interesting portfolio, a lot of things I like. We'll just take a glance. So Apple, Adobe, Amazon, and he's got 3 different ARK ETFs. Now, we don't know his allocations. He just gave me the tickers. So, we can only guess what he puts clients into. And if there are, I think he gave me, let's see how many stocks he gave me here. Well, I've got 24. Some didn't make it in, but what you see, Walmart, Tesla, Square, he's got a 3 times. I'll just start picking out some things here. He's got the 3 times bullish semiconductor ETF. Now, again, these 3 times vehicles they're for trading. You want to buy big dips and, take the 10 to 30% gains when you get them. You don't hold them for a long time, especially because even in a sideways market, the construction of a 3 times ETF means it will actually lose more money or percentage-wise on a daily basis than its underlying index would. There's just this natural erosion and decay because they use derivatives of derivatives to create the positions, and then they rebalance every day. You've heard me say this stuff before. He's got PayPal, Qualcomm, NVIDIA, Google. All right, I'm going to say something good about this portfolio, and then a few words of caution. So when you look at these big holdings, this is a theme that has worked. Everybody talks about FANG. I don't really care about the FANG acronym anymore. I look at, why would you buy Microsoft? Why would you buy Apple? Why would you buy Amazon? Why would you buy Google? And if you understand their growth and you're willing to, be an investor for several years, then you've already answered the question. But you could also follow the smart money. Take a guy like Ken Fisher, of Fisher Asset Management, managing, I think he's got 40 billion under management. He just, he's had long-term positions in Apple, Microsoft, Google, Amazon, and frequently adds, sometimes trades in and out, but he holds core positions. Those are like the ballast for his portfolio. So you can't go wrong there, especially if you're investing in growth and technology for your clients. You can even put Adobe in there. NVIDIA would definitely be in my top 10. PayPal, Square, Qualcomm, really nice things. My only concern with this portfolio is not a lot of healthcare, right? Yeah, let's take a look. Well, he's got ARCG. He's got the Genomic Revolution ETF. Sometimes that's enough. Right now, again, there's so few stocks in healthcare that are even a Zacks #1 rank. You're talking about an industry with 800 companies, a sector with 800 companies that we cover, and consistently less than 10 of them for several months have been less than 10 have been a Zacks #1 rank. So it is hard to pick there, and definitely going with ARC Genomic long term is not a bad idea. So my concern is, when you're this concentrated in technology, what happens if you do get a 10% correction in the NASDAQ? I'd love to ask John, how did he survive the March correction? Because if you get a 10% correction in an index, it usually means you're getting 20 to 30% corrections in some of the leading stocks. So it pays to look at your concentration and then sort of model a stress test. Say, how would I feel if we do get a 10 to 15% correction in an index, and I watch several top holdings go down 20 to 40%. And that's the kind of thing you need to be able to stomach when you're this concentrated. So that would be my only, major concern for a portfolio like this that is heavily tech weighted and concentrated. All right. Sheraz is up next with his portfolio review.
Hi, thanks, Kevin. The portfolio I have picked is from Fendrick Smith. I've added Fendrick's portfolio to the Zacks.com portfolio tracker. It's an excellent portfolio. I like many elements of it, but I have an issue with one very important part of the portfolio that I want Fendrick, as well as all of you, to be aware of. And that's the primary reason why I've picked it. So let's just dive right into Fendrick's portfolio to see the issue that I'm referring to. So as you could see here, this is Fendrick's portfolio, and I'm going to the bottom, and this just lists only 25 holdings in the default position. But let me go to all. And let me scroll down, keep going down, and you get here, and you could see 53 entries. And 53 is way too much. I don't know specifically if this is Fendrick's watch list or the active portfolio that he has. For an active watch list from which you are picking securities for your core portfolio, it is an excellent list of stocks across the board. But if this is the 53 holdings in Fendrick's portfolio, I believe that's way too much, even for someone like me who does this for a living. And some of you may be aware that one of the portfolios I manage for Zacks is this Zacks focus list, which lives within Zacks Premium, and that has 50 stocks. And I know how difficult it is to stay on top of 50 stocks. So even if you are a long-term investor, as the Zacks focus list portfolio is, and even if you are into the buy and hold type of an investment style, even then, managing a portfolio of 53 stocks is way too much. There's no scientific number for what is the correct size for a portfolio, but generally speaking, around 20, 25, 30 at the tops, in my judgment, is something that becomes manageable. The internals of Fendrick's portfolio is excellent. It's a blend of small and large caps, up-and-coming technologies, as well as blue chips. It has a fair amount of technology. It has consumers. It has industrials, but a ton of technology and a ton of business services. Even describing Fendrick's portfolio as being diversified, I still couldn't fail noticing that in two key areas, Fendrick was really underweight. One is conventional energy, and that's a situation I encounter with a lot of client portfolios. And then finance. Fendrick has MasterCard and Visa, which gives you some exposure into that arena, but nothing in conventional banking and brokerage and money management and insurance. And personally, from my standpoint, when I make recommendations, and given the outlook we have for interest rates and for economic growth, I think that's the type of omission that better be deliberate. So all in all, an excellent list of stocks, particularly excellent if it's a watch list. Too much on the big side and unwieldy side if it's a portfolio you're actively managing. The omissions in terms of sectors that I pointed out, if they're deliberate, that's perfectly fine. But all in all, an excellent group of stocks, industries, and sectors that I believe Fendrick has done an excellent job with.
Here are some things you can expect to see coming up. Our mobile app includes features just for Zacks Ultimate members. In addition to having access to real-time pricing data from BATS, you can opt in to receive trade alert notifications and service updates for each portfolio you follow. Plus, be sure to check out the latest version of the 7 best stocks for the next 30 days weekly report, where Zacks experts reveal 7 stocks handpicked for immediate profit potential, posted on the Zacks Ultimate homepage. And the next Zacks Ultimate Strategy session will be posted in early July, so start thinking of submissions for the Zacks mailbag and portfolio makeover segments.
My top pick this month is AMD. And you know I love NVIDIA, but I'm not telling people to start positions in NVIDIA or even add at $700, which was my first target for this year. I'm looking for $750 maybe by Christmas, maybe by next year. But AMD is super cheap. Go back and watch this thing I did last year. It is still relevant when AMD just blew the doors off of Intel because they're going, sub 7 nanometer and Intel can't do it. Watch this video. Big props to Dave Bartosiak for buying AMD a few years ago with blockchain at $16. Release the Ryzen. That video has, I use a slide presentation from last year for AMD, and it's just worth looking at because they're doing all the same things as NVIDIA. And so what's the difference between them? Well, I can still consider NVIDIA the higher quality innovator here, but AMD, I mean, is it Lisa Su, I forgot her last name, the CEO? You know, they're innovating just as much, and they're all in all the same areas. So watch that video. You'll see. Now, if you want to see the most recent slide presentation, you can anytime. Just just go to the website. Here's a this is from May, and you can see that they're in all the same areas as NVIDIA. And my argument is, right now AMD is trading 6 times forward sales at $80. I don't know why it's so cheap, but I think it goes to 100 this year. And NVIDIA is trading 15 times sales. AMD 6 times forward sales. NVIDIA over 15 times forward sales. I think that's a disconnect, and you want to be a buyer of AMD. So I talked about, I mentioned release the Ryzen, how they're taking down Intel because they're going to, sub 7 nanometers. Radeon in gaming, Epic in data center, Instinct in data center. Let's just look at the estimates real quick to show you why they're trading. It's $100 billion market cap, and here we are. Good shot to get near 15 billion this year in sales. That's 50%. That's a 50% bounce back. I mean, obviously semiconductors are on fire. I'd have you buy ASML too, but I think AMD offers the better value right here. So looking at busting through 16 billion next year, that would still be 13% growth. And that is why I think AMD offers unique value here in semis. Buy it at 80. We're looking for 100 in the next 6 months. All right, thanks.
My top stock pick for this month is in the furniture side. Now, several of our newsletters already own the furniture stocks. I own Herman Miller in the Value Investor, and Maddie owns Ethan Allen in Income Investor. I like both of those companies, and I was going to pick one of them, but I decided to go with Haverty, ticker HVT. And they're in the Southeast and Midwest. So if you haven't heard of them, it's maybe because you're not living in the areas where they have their galleries, but they're in 16 states. So they've been around a long time, and furniture is hot no matter what the company. Let's take a look at what is happening with earnings and revenue with Haverty, because it's looking really hot. So this is Haverty's deep dive here, and you can see it's very lightly covered. We only have one estimate, which is maybe why you've never heard of Haverty, but these smaller cap companies have just fewer analysts covering them, and Haverty is one of those. But as you can see, things are looking up on both the sales and the earnings side. So sales here, we have 25% sales growth here going into 2021 after a hot 2020. Once the pandemic lockdowns eased heading into last summer, everybody rushed out to buy furniture. So the backlog is long for Haverty and all the furniture makers. You're waiting longer to get it, but that's because of the demand. So we're having another 25% sales demand here. And then earnings, look at this. Earnings expected to be up 113%. They made 188 last year, going to make 402 or thereabouts, according to this one analyst here in 2021. And so that's pretty hot. You can see on some of the revisions here, they were much lower just 2 months ago until those earnings came out. And then they saw, hey, these trends of nesting are not changing, and then boop, popped it up, almost double here for 2021. And in my opinion, it's probably going to be a little light given what is really happening underneath the scene. We're hearing from more of the other furniture makers now, including like Williams and Sonoma and RH, and they're all seeing these continuing very hot trends. So the trend is our friend here with the furniture makers. This is a Zacks #1 rank, And you can see it's been super red hot on the chart. Now, this is what's maybe going to give some of you pause, like, how much more does it have? This is a 5-year chart and, completely busting out here and still just running. It's right at those all-time highs here, in 2021, but it's only trading at about 12 times forward earnings because they're now expecting that $4 a share, earnings. So as those earnings rise, the PE is remaining relatively low. Haverty is also shareholder friendly. They have good, cash flow and management. They will reward shareholders because look at this on the chart. They had to reward you for holding all those years while the shares basically did nothing. And so you're getting a dividend yielding 2.1%, which is pretty solid, especially given the run in the stock. So Haverty's my furniture pick, but any of them are good to go right here. And many of them are Zacks number 1s or Zacks number 2 buy stocks. So look at the whole sector, figure out which one you understand and which one you like, and go for it because there is more to come on the furniture side here in 2021 and into 2022.